Hello, fellow Rebel Capitals. Hope you're well. So we had Scott Bessent come out just yesterday and talk about how the Treasury might do QE. That's right. Not the Federal Reserve doing QE, but the government itself. So we got to dive into exactly what's happening and then try to ask the question, could the Treasury, could Donald Trump himself do quantitative easing? And what on earth does that mean for inflation or the quote unquote independence of the Fed? And what on earth is he talking about? How can they do this? They can't create bank reserves. So let's get into this right now. I'm going to do a screen share and we're going to go right over to Bloomberg and see what he is talking about. It was interviewed down in Argentina, of all places. And here we go. That's not it. There we go. That's it. Bessent says Treasury has big toolkit if needed. Whenever I hear one of these central planners talking about having the tools for this, Jerome Powell says, "Oh, we've got this. We've got a tool for that. We've got a tool for that." It's like karma. Every single time they say they've got a complete toolkit, or that's what they imply, something happens and they have to mysteriously create another tool that they didn't have. Remember, Powell was saying this prior to the BTFP and prior to Silicon Valley Bank blowing up. This was back, pre-March 2023. So it's like, oh, are you worried about this? Or, oh, no, we got a tool. We got a tool for everything. Like, you guys don't even understand. You think that the only tools we have in the toolkit are just interest rates and QE. No. We've got the MILF and we've got the ATFR9 or whatever they call it. They always have to have some stupid acronym or abbreviation for these programs. And that was always the favorite. That's the channel favorite, was the MILF. It was, and again, that's a lot like that yellow star we talked about yesterday. It's like when they created the MILF program, and I'm not kidding. Look it up. This is during the cerveza sickness. We were doing videos on it. It was like the MIL like FF facility or something like that. I'm like, didn't someone sit down and just whisper in Jerome Powell's ear, hey, we might not want to go with the MILF abbreviation. We might want to switch it up a little bit there. Might not look too good. But no, like nobody says that. Or do they just not care? Same thing with the yellow star yesterday. We might not want to put a yellow star on people's license. Or is that not even a topic of conversation? Is that like taboo? Is that like politically incorrect? I don't know what the hell is going on. But anyway, Powell coming out in 2022 and we got a tool for this, got a tool for that. And then magically we have the blow up of Silicon Valley Bank, and they didn't have a tool for that one. They wouldn't, they had to create another tool, a BTFP. And now they're talking about creating another tool, the Fed, because the basis trade might completely blow up. It's already starting to blow up, but that might have systemic risks, and they want to bail out all their billionaire hedge fund buddies. So they're going to have to set up another tool for that. And so I'm curious, Bessent is saying the exact same thing. And my point is, whenever Powell says that, it doesn't end well. And they mysteriously never have a tool for the problem that actually occurs. So getting back to this article here, Bessent says he has a tool for bonds. Really? Okay, let's see what it is. So Treasury Secretary Scott Bessent played down the recent sell-off in the bond market, rejecting speculation that foreign nations were dumping their holdings of treasuries. Now, I'm going to be harsh, just like all these politicians and central planners. I'm going to be very, very harsh when I think they're doing something stupid or they're lying or, a variety of other things. But those are the two main that I just despise. But I'm also going to give them credit when I think they say something that's smart. So here we go. Bessent says, I don't think they're dumping, meaning treasuries, the foreigners and foreign investors. He says, Bessent reiterated the interpretation of the decline being mainly a product of deleveraging. I have no evidence that it's sovereigns. I think that's a pretty coherent statement based on what's happening. I mean, do we have evidence that it's sovereigns? To his point, no. And we could just speculate, but I highly doubt it is, because those sovereigns need dollars. So maybe them dumping treasuries, but to Scott's point, it's more of a deleveraging. So, and meaning that they need the dollars, they need the liquidity. Whether it's a hedge fund deleveraging because they get caught up in the basis trade, or it's China dumping treasuries because they have to have those dollars because their economy is crashing and they don't have the dollar cash flow to prop up their banks and then prop up really the Eurodollar banks that were propping up their Chinese banks, because they need these dollars coming in. So they have to dump those treasuries. They're forced to sell. They have to sell. It's not that they want to sell. And I think that's his point with the deleveraging. And I would agree. I think that's smart. I think he hits the nail on the head there. We are a long way from needing to take action. Today, last week, you're not that far away. If you're that far away, Donald Trump wouldn't have backpedaled on the tariffs, would he? So we're further away now than we were last week. That's for sure. But I wouldn't go so far as saying we're a long way away. But we have a big toolkit we can roll out. If so, included in the toolkit is the department's buyback program for older securities. But see, he's assuming that it's off the run stuff, and it probably is. It probably is. But what if it's not? I mean, I think he's assuming it's off the run just because that's the problem we had in 2020. And what's the saying? The generals always fight the last war. So maybe it is, maybe it isn't, right? And what's the difference between on the run, off the run? So if you have a 1-year treasury and you issue them today, so Scott Bessent comes out and he issues 1-year treasuries. Okay, those are the on the run treasuries because they're the most recent. Now, if in, let's say, 3 months, you issue another round, a brand new round of 1-year treasuries. Now, all of a sudden, the treasuries you issued today are off the run because we've got another run of treasuries that are newer. So it gets very technical, but the off the run treasuries have less liquidity. The players, the global, the dealers and whatnot, the global dealer banks, the intermediaries, all of the entities really that are in the plumbing of the financial system, they prefer the liquidity that those on the run treasuries have. And so what we saw during the cerveza sickness is a blow up in the treasury market, but it was really with the off the run treasuries. That's where we had a big problem. So if you had, let's say, on the run 1 years and off the run 1 years, the off the run 1 years was where there was no liquidity. That's where the yields blow up, but then that brings up the yields of the on the run. You see, so this stuff gets complicated, right? But what he's doing there is he's saying, okay, well, if this happens again, then what the Treasury can do, they call this the buyback program. And they've been doing this, by the way, for the last, I think, 2 or 3 years. But he's implying that they could ramp it up and they could do almost unlimited amounts based on what the market needed. So he's saying, all right, let's say we've got some 1 years out there that are off the run. And he wasn't planning on issuing more 1 years. But if those are having a problem with liquidity, he can issue 1 years tomorrow to take the dollars to buy the off the run 1 years. You see? So he's just issuing more on the run to buy the existing off the run that is getting into the liquidity issues and therefore bringing up all rates. So that's what he's talking about here. The Treasury last year began their first regular buyback program since 2002. designed to improve liquidity. Another thing he could do is he could just, and Yellen talked about this when she was in his position. Basically, it was kind of like an Operation Twist, where I forgot what she called it, but let's say you've got 10-year treasuries out there at the long end of the curve, and those things are blowing out. You could just issue 1-month treasuries, because those are going to be far more tied to Fed funds. So the Fed would have much more control over what's happening at the front end of the curve than they would the long end of the curve. So you can just go ahead and buy all those 10 years with the 1-year treasuries. Now, then you'd have to ask the question, does that increase growth and inflation expectations? Because if it would, then it doesn't really matter how much they buy to a certain extent, because the yields would still go up. Because at the end of the day, the long end of the curve isn't really based on how much the Fed is buying or how much the Treasury is issuing. It's far more about growth and inflation expectations, as you guys know from watching my videos. So getting back to the article, I guess that would be another tool in the toolkit that Scott didn't even mention. Designed to improve. Okay, older securities are less frequently traded than newer, so-called on-the-run treasuries. In the past episodes of official intervention in the market, the Federal Reserve has been the main actor, buying up large volumes. But see, he talks about Powell in a moment here. But if it got to the point where this was really a problem, I mean, Powell's going to step in. I don't really think that Scott would need to step in. And, Powell's going to get some huge cover, most likely, because if you didn't watch the CPI last week, it's down to 2.4. And the main reason it came down by 0.4% was because of energy. Well, that was the energy prices in March. In April so far, energy prices are a lot lower. So if that energy component is what brought down the CPI from 2.8 to 2.4 last week, I don't see why next month when we get April's CPI that it wouldn't be very, very close to 2%, if not below 2%, all else being equal. So my point is the Fed's going to have a lot of cover that if something gets unorderly, let's say, in the Treasury market, like we saw during 2020, the Fed can step in. Now, what would the Fed do? The Fed would just print bank reserves. Like no matter what they call the tool, whether it's BTFP, MILF, whatever, it's still the same thing. They're just printing bank reserves to buy treasuries and then just hoping that fixes the problem. Look, mechanically, it really doesn't do anything, but it's all about market psychology at the end of the day. It's just like when the Fed stepped in and bought corporate debt. I'm sure you guys remember that back during the cerveza sickness. They only bought like $1 billion worth of this stuff. And let's just say that the market is $3 trillion. They only buy $1 billion, but that's all they had to do, because that sends a message to the market that the Fed has your back. They put in basically a Fed put. And therefore the market comes in and does all the buying. So mechanically, they didn't really do anything. It's just psychologically that brought the liquidity back in because people had the confidence to buy and sell. So this chart shows how treasuries have tanked and what they did last week, which was unusual, but not unprecedented. It is true that you see the biggest weekly drop since 2001, which tells you something in and of itself. But we've seen drops like this during the cerveza sickness, and we saw drops like this in September of 2008, along with the dollar going down and the stock market being very, very volatile to the downside. But look at what's happening more recently. I think a lot of the headlines that I see today are really taking last week's headlines and just extrapolating them forward indefinitely into the future. And I don't know if that's a real good idea. If you guys watch my interview or my conversation, more like it, with Bob Murphy, and I'd strongly suggest that. It's really, really, really good. That's on the Rebel Capitalist Interviews channel. But we talk about how my view is that you kind of have a snapback with the dollar. And I would guess you probably have a snapback with treasuries as well. Why? You have to watch the interview to find out why I say that. But look at what's happening with the 10-year. So it's down a bit. I mean, not 4 basis points today, but look, we're all the way back down to 4.33. So it's like you have all these headlines that yields are blowing out, but things are changing so quickly by the time they come out with these headlines, and by the time everyone's talking about this narrative, yields have started to go the opposite direction. And by the way, it's the same thing with the dollar. Look at the DXY today. Up over 100. So, what was 99.5 a low? We'll see. We'll see. Anything's possible. But like I said, I mean, I got the concept, assuming we go back to 102, 103 or higher, I got the concept right. Remember when we did a video on this last week where it tanked like down to 100.5 or something. Remember, it was down like 2% one day. And that's when I did a video on it. And I said, my base case is that we snap right back to where we started, 102, 103. But what I got wrong is I did not think we would go all the way down to 99.5 before we snap back. So we'll have to watch this closely and see what happens. But again, all the headlines right now are yields are blowing out and dollar is crashing. But that's focusing on last week. When we focus on this week, we see it doing the opposite. Where were we here? Okay. So this is going back to Bessent. Now he's talking about Powell. In the latest weekly sit down with Fed Chair Powell, there was a discussion of concerns about Treasury market. Bessent said specifically, did we discuss some kind of break the glass? I think we're a long way from that. Pressed on whether Powell was concerned, he said, I think we have heard from Fred, from the Fed chair, if that were the case. Out of all the people in Trump's administration, I definitely like Bessent the best, by far. There's not even a close second. He's fantastic. Well, I guess I'm talking about from the economics standpoint. I mean, you could talk about Tulsi Gabbard and RFK and all that stuff, but that's not really with the economic stuff. As far as the people that are surrounding him that are guiding or discussing his economic policies, Bessent is just head and shoulders better than the rest. Even though I disagree with him on a lot of things, at least he's an adult in the room. These other guys are complete clowns. What was the Lutnick dude and the Navarro? Come on. Is that the best we can do? Like really? These guys, I completely agree with Elon as far as his assessment of Navarro. But Bessent, good. Sharp guy. So he says that we need to maintain the independence of the Fed. Okay, of course he's going to say that. I think this is interesting. Bessent says one of the lessons from his career as a hedge fund manager, not to look at what happens over the week. Trading history is the scar tissue that sticks with you, he said, recalling the 1998 bust of long-term capital management, which he said had nothing to do with anything other than investors acting with excessive leverage. Not really, Scott. Not really, buddy. I think he's not wanting to get into too much detail there. But what was the LTCM blow up really about? It was the exact same thing as the GFC. What we had is we had, because of the Eurodollar system, we started to get this network where all of these balance sheets globally became interconnected and intertwined, right? To the point where if one of these balance sheets, you know what it's like? It's like that movie, Christmas Vacation. And for a lot of you people that are my age, I'm sure you remember this when you were a kid. Remember when you would have those string of Christmas lights and you would wrap them around the tree outside or put them on your gutters or whatever it was. But if one bulb was out, then the whole thing wouldn't work because the electricity had to flow through each and every bulb. So you'd have to go through there and check every single bulb to make sure that it actually worked. or it was very frustrating. For you younger people, that's what life used to be like. I'm sure they don't make Christmas lights like that anymore. But my point is the global monetary system's very similar. So you have this daisy chain of Christmas lights, and long-term capital management just happened to be one bulb. So you just take out that bulb and the whole thing just takes a dump. And it's not necessarily that it was that one bulb. It was more so that the system's retarded. Like the system's extremely fragile. We don't want a system, or we don't want a string of Christmas lights that is so dependent on each individual light. We want one that's far more robust. So in my view, that was the problem with LTCM. And by the way, that's why the Fed had to step in and bail them out. Basically, they had to negotiate a bailout. If it wasn't a systemic issue due to what we're talking about with the Christmas lights and the network of balance sheets, and if it was just like Bessent is saying, just excessive leverage issue, then you just let them go bust. Who cares? Who cares? It's just like letting the corner grocery store go bust. Yeah, all right. That's how much systemic risk does that have? Okay, a couple people lose their jobs. That's free market capitalism. So I would kind of push back against that. So Bessent rejected concerns about the simultaneous decline of Treasury of the dollar last week, signifying U.S. was losing its haven. I agree with him here too. We're still global reserve currency, strong dollar policy. I don't know about that because it's tough to bring manufacturing back to the United States, and it's tough for these tariffs to have teeth if the dollar is going up, right? Because the dollar basically counteracts or offsets the tariff itself. And I talked to Bob about this as well, because what happens is let's say the widget maker in China, their profits are denominated in yuan. So if they have to make 100 yuan in profit per widget, well, they don't really care what they sell the widget for in dollar terms. So Trump puts the tariff on, they just drop the price in dollars to where the price at Walmart is still the same. And it doesn't give the American producer the edge. And they're able to do this because the dollar going up means that even though they're selling it for fewer dollars, they're getting the exact same amount of yuan into their bank account for each sale. So there's a lot of reasons why I would say, are you sure, Scott, you really want a strong dollar policy? Because that contradicts everything else that you're trying to do. The Treasury chief was visiting Argentina to show support for the country after it received a new round of IMF funding last week and met earlier with Javier Milei, a noted supporter of Trump. Yeah, but I just wish Trump would be more like Milei, right? Afuera, afuera, afuera. I don't see much afuera. I see a lot of central planning and Trump trying to be a puppeteer. But we'll save that for a separate video. All right, guys, enjoy the rest of your afternoon. As always, make sure you're standing up for freedom, liberty, free market capitalism. Are we starting another round of QE? Yet Treasury, government, Trump QE is what we'll have to call it. You can let me know in the chat, and I will see you on the next video.